By the help of this indicator, you can delete your false signals. I will teach you a very accurate trading strategy based on this indicator, so make sure you watch this video until the end and let's get started. But before I add the indicator, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, to add this amazing indicator to our chart, here we click on indicators and we search VQZLZ score, this one, which is an editor specs indicator and written by Steph XAGS. Alright, this is the indicator, and as you can see, it's added here below the chart. This indicator is an enhanced version of volatility quality zero line indicator, which is basically used to identify range market where the price is moving flat. In this indicator, Z-score probabilities are also applied to the original VQZL indicator. So here, this indicator is standardized, and so it can be used for analyzing any asset or market. In case if you don't know, in statistics, Z-score probabilities show the relationship between a value to the average of a group of values, and just know that in trading and investing, Z-score measures the variability of the asset, so it can help us to determine volatility and its probability for different levels of the market. This indicator compares the current volatility to moving average of Z-score probabilities. So when the VQZLZ score is closer to the mean, here the indicator will be closer to the zero line, and there is more probability that there is no trend in the market. In other words, the price is moving flat in a consolidation period. On the other hand, when the VQZLZ score is far from the mean, we have more probability that the market is trending and it is out of flat market. And this is exactly what this indicator is showing us. By the help of statistical principles and Z-score probabilities, it helps us to know if it is more likely that the price is trending or not trending and moving flat. There are different thresholds in this indicator, and depending on the levels of the threshold, the histogram will have different colors like gray, yellow, orange, red, or green. And these levels of threshold are also based on statistical confidence levels with probabilities of approximately 90%, 95%, and 99%. Alright, now let me teach you how you can interpret this indicator, and then I will teach you a trading strategy. But before that, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. Alright, getting back to the indicator, as I mentioned earlier, depending on the levels of the threshold, the histogram will have different colors. We have yellow, orange, and green when the histogram is above the center line, and we have yellow, orange, and red when the histogram is below the center line. And we have also gray color whether the histogram is above the center line or below the center line. When the histogram is above the center line and the color is green, we have the highest probability that we have increased volatility for advancing of the price. And on the other hand, when the histogram is below the center line and red, we have the highest probability that we have increased volatility for decline of the price. When the histogram is yellow or orange, it shows lower levels of probability. So yellow is the lowest, orange is medium, and green or red are the highest probability. We also have another color which is gray, and this is actually when the Z-scores are close to the mean, so giving the probability that the price is moving flat in a consolidation period. For example, here when we check the price action, we can see that the market is flat, and when we check this indicator, we can see that the indicator, the histogram, is gray. Or here in this part, during the pullback, you can see that the price is flat and the indicator is gray in this period. Or another example here, you can see that the price is in a trading range and moving flat here in this time period. And when we check the indicator, we can see that the histogram is gray. So you can see that by the help of this indicator, we can determine when the volatility is low, and so probably the market is flat. And when the volatility is increased, and so probably the price is gonna advance or decline. Now you may wonder if you can only rely on this and enter a trade when we have color changing from gray to yellow, orange, or red and green. No, we don't use this indicator alone for entering a trade because you can encounter many false signals, especially during pullbacks or trading ranges when there is increase of volatility but not enough to have an extended price movement in that direction. The real use case of this indicator is for further confirmation of the buy-sell signals that you have in your trading strategy. Let me show how you can do it. Alright, now I want to teach you a simple trading strategy so you better understand how this indicator is used in practice. Here we click on indicators and we search Andean oscillator, this one, which is an editor specs indicator and written by Alex Grover. Alright, this is the indicator, and as you can see, it's added here below the chart. This is a very powerful trend indicator that can help you also with non-trending market, and it is a perfect match with this indicator. You can see that we have three lines here, red, orange, and green. When the red line is above the other two, the price is declining, and when the orange line is above the other two, the price is moving flat, and in times that the green line is above the other two, it shows that the price is advancing in an uptrend. Let me show how you can trade based on this setup. We're going to take 10 consecutive positions and see how much is the accuracy. For a short position setup, we want a situation like this where the red line crosses above the green line and then it crosses above the orange line. We don't take crossings like this where the red line goes below the orange line and then again crosses above the orange line. This is not accepted. We only take a crossing like this where the red line crosses above the green line and then it crosses above the orange line. When the red line is already closed above the orange line, here in this indicator, the histogram should not be gray. The histogram should be below the center line and the color should be yellow, orange, or red. So here the sell signal is confirmed, and in practice we could enter a short position at this point with the stop loss above the previous swing high and profit target at 1.5 risk to reward ratio. And for a long position setup, we want a situation like this where the green line crosses above the red line and then it crosses above the orange line. When the green line is already closed above the orange line, here the histogram should be above the center line and not gray, which is not the case here. So here the buy signal is rejected. Moving on the chart, here you can see that we have a short position setup. You can see that the red line crossed above the green line and then it crossed above the orange line at this point, but the histogram is gray. So this sell signal here is rejected, and after that we have another short position setup and this sell signal here is confirmed because you can see that the histogram is below the center line and the color is red. So in practice we could enter a short position at this point with the stop loss above the previous swing high and profit target at 1.5 risk to reward ratio, and you can see that this trade was also a profitable trade. Here you can see that we have a buy signal, but this is rejected because the histogram is gray, and for this sell signal here, this is a confirmed signal. So in practice we could enter a short position at this point with the stop loss above the previous swing high and profit target at 1.5 risk to reward ratio. Moving on the chart, here we have a buy signal, but this is rejected because you can see that the histogram is gray, and for this sell signal here, this is also rejected because the histogram is gray, and then we have a buy signal here, and for this buy signal, this is a confirmed buy signal. So in practice we could enter a long position at this point with the stop loss below the previous swing low and profit target at 1.5 risk to reward ratio. Moving on the chart, here we have a short position signal and this is a confirmed signal. So in practice we could enter a short position at this point, and this is also a profitable trade as you can see. Moving on the chart, here we have a sell signal, but this is rejected. After that we got a buy signal here and this is confirmed, so we could enter a long position at this point with the stop loss below the previous swing low and profit target at 1.5 risk to reward ratio. Moving on the chart, here we have a sell signal and this sell signal here is confirmed, so we could enter a short position at this point with the stop loss above the previous swing high, and this is a profitable trade. As you can see, after this trade we had another short position signal here, and for this sell signal, this is also a confirmed signal. So in practice we could enter another short position here at this point with the stop loss above the previous swing high, which is at this level, and profit target at 1.5 risk reward ratio. Moving on the chart, we have a buy signal here, and this is confirmed, so we could enter a long position at this point with the stop loss below the previous swing low and profit target at 1.5 risk reward ratio. After this trade we had another long position at this point, but this is rejected because you can see that the histogram is gray. And for this buy signal here, you can see that after the green line crossed above the red line, it couldn't successfully cross above the orange line. We want a clear cut like this, but in this case you can see that the green line was just running on the orange line. This is not accepted. Moving on the chart, here we have a short position signal, but this is rejected. Moving on the chart, and for this buy signal here, this is confirmed. So in practice we could enter a long position at this point with a stop loss below the previous swing low, and this is also a profitable trade. As you can see, we have another buy signal here, but this is rejected. And for this sell signal here, this is a confirmed sell signal, and in practice we would enter a short position at this point, but this is a false signal, and you can see that the price didn't decline after that, and instead we got a reversal and the price advanced after that. And this is the important point that you must pay attention, because although this trading strategy is very accurate and we could have 10 winning positions out of 11 trades, but we can still encounter false signals. There is no trading strategy with 100% win rate, and losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it is one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.